The non-farms payroll report, the monthly U.S. government jobs report came out this morning, Friday, September 5th, and it was weak, solidifying market expectations that the Fed will be forced to cut rates on September 17th. In the meantime, gold and silver continue to move higher since our August 18th update, where we explained how lower rates benefit precious metals. Gold is up 7.5% and silver is up 8.5%. In this gold market commentary, we'll look at the latest charts for precious metals, review the U.S. jobs report, go through a little bit of other U.S. economic information, including yields, which are tumbling, and we'll look at a couple of other things that are helping to push gold a little higher right now. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We're a national physical precious metals and vintage U.S. gold and silver coin dealership. If we can help you with any of your needs in the physical arena, we'd love to have that opportunity. Let's get right into our charts. This is a one-year gold chart showing that on a 12-month rolling basis, gold is now up a remarkable 44% for one of the biggest annual 12-month gains we've seen in years, since 2010, I believe. You can see how we've got tagged on this chart at near the end of the consolidation phase on August 18th. Our alert stating lower rates are coming. Gold was 33.36 at that point in time. We've tagged when Chairman Powell gave his August 22nd Jackson Hole, Wyoming speech following the dismal July jobs report that indicated the Fed was open to rate cuts. And now we've tagged just today the dismal jobs report from today, and gold has closed the New York session at 35.89 for another new New York closing all-time high, with gold up now 7.5% since we issued our lower rates are coming alert on August 18th. The gold market looks very solid right now. This is a 6-month candlestick chart for gold showing a little bit more granular detail over the last 6 months. You can see we've seen with that blue rising trend line, a rising bottom with a flat top, and how gold has popped on each of the week statistics we've gotten for a weak dollar, and then a weak jobs report in July, then Chairman Powell's speech. Right before that is that little green circle. That's where we gave our update stating, hey, lower rates are probably coming. And then we've gapped higher over 34.50, which is unusual. And gold has run all the way up to 36.02 intraday just today, breaking the 3,600 mark for the first time after settling just a little bit lower at the close. So gold is looking rock solid. It's going to be a bit bumpy along the meantime. We did see a bit of a down day yesterday leading into today's jobs report, but the dismal jobs report invigorated gold once again, punching it higher. So this market looks very solid to me. It's not going to be all straight up from here, though. It could be very choppy at times. We'll see. But the trend is your friend, and the trend for gold is higher. Looking at the one-year silver chart, we've got a same kind of a pattern with silver going sideways for the last 2 months. We've tagged where our alert came out on the 18th when silver was $37.89 then. It firmed up a bit. Then Powell spoke on August 22nd. Silver hit a 14-year high at 41.25 closing in New York 2 days ago. We saw some profit taking yesterday and a bit of firming up today, just a minimal firming up on today's jobs report, with silver closing at 41.07 in the New York session today. But silver is in breakout mode relative to its trend lines, which you can see in blue. If we look at the 6-month candlestick report and get a little bit more granular detail, You can see the trend lines are very distinct. And then silver has broken over to the top of that trend line, signaling a clear breakout, but it's still tentative. And like gold, silver has a gap in the chart, which is very unusual. Now, that's over the Labor Day weekend, just last weekend when we were closed on Sunday and Monday going into Labor Day. So that's why we've got a gap up both in gold and silver. And there's a couple other things happening that are helping to buoy the metals besides just what the Fed is talking about, lowering rates. We'll get into that in just a minute. Looking at the gold to silver ratio chart, the ratio has been pretty steady at about 87.5 to 1, with gold at 35.89 and silver at 41.07. So relative to gold, still silver remains undervalued and clearly a bit better buy in our opinion. As we said, gold's up about 7.5% since we issued our August 18th update, and silver's up 8.5%. We do think silver can outpace gold a bit going forward, perhaps by as much as 3 or 4 or 5 percentage points. So we still continue to favor silver a little bit more based on relative value in the current market. This is the report that we've been waiting for. The August non-farms payroll report showing that just 22,000 new jobs were created in August, which is remarkably low. The July figure was was revised upwards rather by about 6,000 jobs to 79,000. Meanwhile, the June jobs figure was revised lower, 25,000 jobs to minus 13,000, or a loss of 13,000 jobs in June, the first negative jobs print we've seen since we can't remember. So the employment market is looking very weak at the moment. There are fewer job openings. It's taking longer to get a new job. If you lose your job, we're seeing unemployment claims starting to edge higher. And the unemployment rate has ticked up 0.1% as well on this dismal jobs report, from 4.2% to 4.3%. So clearly, Chairman Powell was correct in deciding to defend the employment sector of the market over inflation just 2 weeks ago at the conclusion of his August 22nd speech, because the U.S. economy is a consumer-driven economy, and jobs fuel the consumer. So weaker jobs means a weaker consumer, means a weaker overall economy. And when job losses start to occur, they can tend to snowball and accelerate pretty quickly in a weakening economy. We're not sure if we're at the edge of that phase or not yet, but this is what Chairman Powell is obviously concerned about. Looking at unemployment claims, they're starting to edge higher as well. We've looked at this chart a couple times over the last 6 months. Right now, the latest unemployment claims came out at 238,000, which is about in the middle between 220 and 260. It's not unusually high yet. We've had a couple ticks as high as 260,000 new unemployment claims, but the trend is rising, like for gold and silver, which does not bode well. And this weekly unemployment claims chart is remarkably choppy as well, but when you see the unemployment claims trending higher, that's not a good sign. Now, in addition to all this, something else is going to happen next Friday, September 9th. You might remember last year at this time, the U.S. revised downward the job creation from March 23 to March 24, 818,000 jobs. Well, we're going to get the annual estimate of revisions lower on September 9th. And no one is really paying attention to this report that's coming right now, but we are. This downward revision is the difference between the monthly BLS survey, which is a survey of employers in the U.S., which is notoriously weak in response rate and choppy, against actual state-by-state monthly unemployment claims that are filed, which is a much more granular granular, and accurate report. And it was a shocker last year when it was revised downward 818,000 jobs from the initial BLS statistics. Now, this next Friday's report on the 9th is going to be from the period for April 24 to March 25. During this period of time, the U.S., according to the BLS, created 1,758,000 new jobs. Analysts are estimating a downward revision of between 475,000 and 900,000 jobs once the state-by-state unemployment claims are analyzed. This means between a quarter and a half of the jobs that the U.S. economy allegedly created over the 12-month period from April to March, April 24 to March of 25, could be revised lower, which might make the Fed even more aggressive in their rate cutting cycle that they're going to start on September 17th. But we'll be looking forward to see what this estimate of the revisions are. It's not the final revision, but it's an estimate of where they're going to come in. Last year, it was a shocker and a head turner. We'll see what this brings next week. But this will certainly come into the Fed's calculations as well over where they set the federal funds rate at their September 17th meeting. And speaking of where they're going to set the rate, the market is now anticipating that as of December, this is as of the end of the year now, market participants, according to the CME Fed Watch tool, where this is where market participants actually bet where they think the federal funds rate will be. 70% of participants think that we'll have 3 quarter-point cuts or 75 basis points lower federal funds rate by the end of December. And this is up about 20% and a quarter point from where it was just this morning before the dismal August jobs report came out. So market participants are betting that the Fed will cut rates 75 basis points or 3/4 of a point before December is over. Time will tell. Here's a headline from MarketWatch today. Stocks turn lower and bond yields in the dollar tumble. And they have. We'll go over those charts in just a second. As job market weakness jolts investors. Well, following July's dismal report, I don't think August's dismal report is that much of a jolt. It certainly hasn't been to us. We've got the unemployment rate near a 4-year high now at 4.3%. But down at the very bottom, that small headline, stocks and bonds, treasury bonds aren't the safe haven they've been in the past, and taxpayers will pay a price. Well, we're seeing something happening in Great Britain right now that may be a precursor for what happens in the U.S. And that's one of the things that's helping to buoy gold as well right now. We'll get to that in just a second. Here's a 1-year dollar index chart. You can see the dollar's tumbled over 10% this year since the start of the year. It's gone sideways over the last month or so, but now it's edging lower. It's down about a 0.5 point today on this week jobs report to 97.75. And it looks like it could break that little support level it's got at about 97.6 and head lower from here. That's what we are expecting. We're also seeing yields tumble on the release of today's jobs report. And you can see that on the 10-year treasury yield here in red, way off to the right where the jobs tag is. And the same thing with the 2-year treasury yield in purple. So they have been both been trending lower, but now they've taken a tumble lower following the release of this morning's jobs report. This includes today's market action. You can see the federal funds rate in black is up at 4.35%. I've added 3 little black arrows to the right that show where the federal funds rate will be if they cut a 1/4 point, a 0.5 point, or 3/4 of a point. Right now, the Fed could cut a 1/4 point and the 10-year treasury yield will still be below where they are. And if you look at the 2-year treasury yield, it has fallen all the way to about 2.45%. That's where the market thinks the federal funds rate is headed to. So the market is betting, based on the 2-year treasury yield, that we'll get 3 federal funds rate cuts or 75 basis point cuts. So the way things are shaping up, we might actually get a half-point rate cut at the end of the September meeting. That's very possible now, depending upon this jobs revision report that we're going to get on September 9th. So there's a lot going on right now with the employment sector of the U.S. that's going to cause the Fed to react. And we just don't know how much they're going to react. But what we do know is lower rates are good for gold and silver. And we're seeing that in spades right now. And this brings us to the UK. British borrowing costs, when they sell their treasuries that are called gilts, have just hit a 27-year high, pressuring the government to bring their finances into better check, their deficits. Remember, when President Trump stepped back from supporting the Ukraine militarily in February and March, Britain, France, and Germany all agreed to go into more deficit spending to make up the gap in military supplies to the Ukraine. That may not actually be possible. But what we're seeing is British finances are not doing well. And the yield or the interest rate that investors are demanding on a 30-year British treasury are rising as a result. They want a greater reward for the risk they're taking in investing in the British government for 30 years. And if we look at a 5-year British 30-year gilt yield chart, you can see that we have just come off of the highest level in the last 5 years, which is the highest level since 1998, 27 years at 5.72%. It's about 5.5% as we close out the market activity this week. But what I've added off to the middle of this chart is the tag when the yield jumped 1.5 between July of 2022 and September of 2022. There was a rejection of British bonds when Chancellor Liz Truss submitted her budget, who ended up being the shortest tenured British premier or British chancellor in history. That was a bond market blowout then, and the yields are even higher today than they were then. And I remember distinctly gold was dropping during that period of time because the dollar was extremely strong. The Fed was raising rates higher and faster than every other central bank, and gold was dropping from 1,800 all the way down towards 1,628. And that 1.5 point British bond blowout caused gold to pop $50 overnight in a shocking move for both. The question is this where the U.S. is headed if we don't get our finances in check, where we'll have to pay continually higher interest rates to attract money to finance our debt, which is at record highs and still going higher? And if we go into a weaker U.S. economy, our debt will increase faster. And higher yields that we'll have to pay on treasuries will increase the interest expense. So this is the rub that British investors are feeling now, and they're asking for a higher rate of return. And we may see that happen in the U.S. if things continue to persist the way they have been. In other news of the week, Vladimir Putin, Modi of India, and Xi Jinping of China all assembled in China this week. I made my first meme. Did you see that gold just hit a new all-time high? I did this a couple of days ago. It was kind of as a joke. But then I went home and I got a little sick to my stomach because the U.S. has been courting India, trying to create a split via India between China and Russia, so that the three of these nations are not so aligned. Remember, President Trump met with Vladimir Putin just 2 weeks ago. And so far, we've gotten nothing out of that meeting with regard to the Ukraine war. And now we've got Modi happy to see Putin and President Xi of China, which means that we're losing the traction that we've been trying to gain with India. Why? Well, we've ratcheted up tariffs on India to 50%, which is meaningful to India. And we've been trying to court India for years now, and we may have just inadvertently blown it. And that's why I'm not happy to see the three of them together. Russia is selling a lot of their oil to both India and China. President Trump's trying to get India to stop buying that oil, but it's not working. And now to see the three of them together is not a good sign for the U.S. going forward. This is helping to buoy the gold price a little bit as well and help to contribute to that gap that we saw over the Labor Day weekend. Which brings me to comparing the gold market from the 1970s to the gold market of the 21st century. When the U.S. unpegged the dollar to gold in 1970, the gold price was about $41 internationally. Between then and the end of the decade, gold went up 5 times in value to $200 an ounce. It dropped 50% to $100 and then gained eightfold to $850 an ounce. This was over a 10-year period, and it was primarily because the U.S. went into a fiat money experiment for the first time in modern history, modern financial history. But since 2000, the whole world has gone on a global debt explosion of fiat currency. And I think that we're in a very similar phase, only instead of it being a U.S.-centric 10-year phase, we've got a global 30-year phase in progress right now, with gold moving up sixfold from 2000 to 2011 to 1890, coming down just about 50%, 45% to 1,050 in December of 2015. And now, since it hit that bottom, it's up 3.5 times, which makes me think back in time to 1978. When the U.S. was experiencing a reinvigoration of inflation, we'd had a new oil shock, and we were about to have hostages in Iran for a year, which cuckolded the U.S. internationally for over a year. And if we get into a similar phase here in the U.S., I'm not saying we will, but if we do, this means that if this pattern is consistent, we'll see $8,000 gold or $7,500 gold. Now, Peter Schiff said this week he's expecting gold to be $6,000 an ounce. I'm still thinking gold could be $4,500 to $5,000 an ounce. I'm a bit more conservative. But the way things are going, I do think we're going to get to $4,000 an ounce this year, which has been my target. In any case, this is a bit disturbing to see these two charts next to each other and to compare where we were then and where we are now and why. So I think it's important that you all consider this and remember that, gold could still run a lot hotter before we finally get to a blow off top. It's very possible. We have 4 great specials in the physical arena. We continue to have a few $10 Indians in MS64 condition, one of the scarcest of the 4 big coins, the 10s and the 20s, at a low premium of just 29% over intrinsic melt value today. We've got British sovereigns, a handful left at 4% over melt. Internationally recognized trading size coin normally trades between 8 and 10% over melt. A handful of British backdate silver Britannias as low as $1.99 over spot, and backdate 1 ounce gold eagles at $99 over spot, all while supplies last. So that is my update. Thank you for your time today. Thank you for all the loyalty and trust that you've placed in us over the last 27 years. Without your loyalty and trust, we wouldn't have a business, and we remember that every single day. If you like what we're doing, please subscribe to our channel. I'm working really hard trying to get ahead of what's happening so you can get ahead of these markets if that's what you choose to do. So you're not just reacting to what's happening. I'm also trying to explain why all of this is happening, not just reporting, oh, gold's hitting a record high. These are the reasons why. So it's important that you understand so you can make educated decisions for yourself. So thank you so much and good luck out there.